Okay, this is going to be a quick video on accounting explained for absolute beginners. You may have seen CPA Strength's videos. I tried watching them a year ago and I couldn't make any sense of it because my understanding was so small. And now after running my business for 2 years, 1920, yeah, two years and a bit, I finally have to figure out the accounting. So I did, and it just clicked, and it makes so much sense that I need to share. So he talks about this chart that makes sense. You have assets, draws, expenses, liabilities, equity, revenue. Now I thought debits and credits, I was so confused. I use QuickBooks. I've been trying to learn to do all my own accounting so I can, at least for my first year of business, but I was always really confused. I didn't understand how anything went because I didn't understand debits and credits. So it's really simple. Each of these categories can either be a debit or a credit on your ledger, on the two transaction system where everything has to equal each other. So an asset, if an asset increases, so you deposit money in the bank, that's a debit. If an asset decreases, it's a credit. Okay, so if you withdraw money from the bank, you're going to credit the bank account or your cash. If your draw increases, I'm just going to shorthand and say it's a debit. If your draw decreases, that's a credit. I don't know how your draw could decrease, but whatever. If your expenses increase, if you buy something at Home Depot, you debit the expense account. If your expenses decrease, if you get a refund from Home Depot, you can credit the expense account. I don't know if you'd actually do that. That might be wrong. If your liability increases, if you take a loan out from the bank, it's a credit. See how it's backwards from this. If your liability decreases, it's a debit. See, if an asset increases, it's a debit. If an asset decreases, it's a credit. So this chart doesn't actually explain, these aren't debits and these aren't credits. This means that these things are debits when they are positive, and these things are credits when they are positive. So I could make another chart that says debit, credit, asset, draw, expense, liability, equity, revenue, because this is the positive chart. Now, oh, I did that wrong. If this is the negative chart, so when my liability decreases, it's a debit. When my equity decreases, it's a debit. When the revenue decreases, it's a debit. If my assets decrease, it's a credit. That's why it's a C. If my draws decrease, it's a credit. And if my expenses decrease, it's a credit. So we'll finish writing this out. Equity increases equals credit. Equity decreases is a credit. Revenue increases equals a credit. Revenue decreases equals a debit. So now any transaction that you come across, you'll be able to identify it as one of these. This is the shorthand version, but it doesn't contain this information. That's what I was missing. That's why nothing made sense to me. But I just figured it out. So we'll set this aside here, sort of. Forgive the shadow of my camera. I'm just doing this late at night because I was blown away by the fact that I was able to figure all this out. So now, loan from bank for 10 grand. Okay, what is a loan? You know that a loan is a liability. And you know that your liability is going to increase because you just got 10 grand. And now also, now that you got 10 grand, that's an asset. It's cash. And your cash is increasing. So now if we go here and we see cash increasing is a debit. So then when you go to your ledger or your journal or whatever it's called, I don't know, I'm not an accountant. Now because my assets are increasing, asset increasing is a debit. So you write 10K bank account. Or you can just say asset. And your credit is going to be a liability because your liability increase, if we go here and look, liability increases means it's a credit. So now if I buy a truck for 5K, so you know, I'm not sure what both of them are, but I know that buying a truck, my assets are going to go down, right? My cash, my bank account is going to go down. So if I look and I see my assets going down, that's a credit. So now I know that at 5K, it's a credit of 5 grand from assets. And then I know if my assets are decreasing, your truck is an expense, right? So my expenses are going up. And if I look here, when my expenses go up, it's a debit. So that means it fits in this side, and expense 5K. It's a debit. So now when I put these together, I know that my bank account is going to look like 10,000 minus 5,000 because 10,000 was debited, and then 5,000 was debited to the expense account. Does that make sense? So even though my expense account is money that I've lost, when my expenses appear, then the expense account goes up, even though I lost that stuff. The asset account also goes up when I gain money. So it's backwards. You would think that if I get $10,000 and if I spend $10,000, then this should be a credit, but it's not. It's a debit. And that's what's confusing. So this isn't these don't equate. Maybe they do in some sort of accounting term that I don't know because I know the very, very basics of accounting. But you can't think of it logically. You have to think of it in terms of only these things. And now we can also look at these always have to equal each other, which means that, and these things also have to equal each other. So if my asset increases, so if we look here, now I'm going to start to get confused. My assets increased. Yeah, assets increased. And the liability also increased. Right, so that's the increase. So which ones did we use? We used this one and we used this one. And so they equal each other. Okay, yes, this does make sense. So we're looking here at my truck. So now I look here at my truck was an expense. So my expenses increasing means it's a debit here. And then my credit was a credit to the asset account because my assets decreased, so it was a credit. So the first one, my assets increased and my liability increased. So these ones go together. You have a debit and you have a credit. Then the second one, my expenses increased and my assets decreased. You have a debit and you have a credit. Even though expenses and assets are on the same side, you can think of this as you have inverse asset. And so when your asset goes down, it becomes this asset over here, which is a credit. So all you need to have is one debit and one credit on each side of this. You don't need to have one liability on one side and one asset on the other side. You just need to have one debit and one credit. And if you write out this list, then you can figure out any transaction you can imagine. We'll do one more. Let's say a draw of $1,000. So now my draw increased. Okay, so that's a debit. So I know that. And what else happened? My assets decreased because I took it out of my bank account, and that's the credit. That's the other side. Even though they're both in this column of the DC Adler thing, you can say my assets decreased by $1,000 equals a credit. And that makes sense. And that made sense for me. And there's no videos that explain this for dumb people who need it explained at the most basic level, which is what I am. I'm not saying you're dumb, but if you have no understanding, you know, I talked to an accountant and everything he said was way over my head because I didn't have this basic understanding. And this is going to take some getting used to. You can go in to QuickBooks, or you're going to have to practice so that this becomes fluent enough, so that your brain is fluent enough in understanding these things and these lists, so that when you say, oh, I bought some office furniture, I can say, oh, yeah, that's an expense, and that's going to debit the expenses, because I get so confused when somebody says debit and credit previously to this. Now that I've just learned it, I'm going to need to practice. Oh yeah, that was an expense. I'm going to debit the expense account, and maybe the furniture is an asset, so you credit the asset account. Now, I hope that makes sense. I hope that helped. Thanks for watching.